Hello, everyone. Thanks for tuning in. Welcome to the latest of our Artemis Live interviews. So today we're going to be talking about Hurricane Ida, a little bit about what we know and what this could mean for reinsurers and for the ILS market as well. Hurricane Ida obviously had a very significant impact on exposed insurers, reinsurers, and ILS funds, and the ramifications are being felt well into the retrocession market after another heavy industry catastrophe loss year. Now, while estimates for the industry loss from Hurricane Ida still range from as low as 20 to 25 billion to as high as 40 billion, for the market to really understand what's going on here, it's important to look at the facts on the ground, the way the claims data is flowing through the market from underwriting companies, and to consider really what kind of tail there could be for this event as well. So, who better to help me dive deeper into this issue than Verisk's PCS unit? And I'm delighted to be joined by regular participant Tom Johansmeyer, head of PCS, but also Ted Gregory, director of operations at PCS and ISO Claims Analytics. So thank you both of you for joining me. It's great to see you.
Thank you.
Thanks, Steve.
So with the reinsurance renewals fast approaching, it looks like Hurricane Ida's continued development is going to be one of the many factors this year that drive market conditions towards 1/1. But perhaps to begin our discussion, Tom, you could give our viewers a bit of an overview of what we know so far on the industry loss side of things.
Well, what we know is interesting, right? So I talk to reinsurers every day. And just to be clear to everybody, the work Ted and his global ops team does, they do separate and apart from what I look at. We've made the conscious decision that I will not be part of that process so that I can talk to reinsurers and ILS funds frankly and honestly. And this allows PCS to do our core job right. And let me tell you, I don't think I had anything to do with Ted and his team are doing. And also it allows us to really optimize how we serve our client, which is why, we're able to be kind of, shoulder to shoulder with reinsurers on the one hand, and then through the ops team, shoulder to shoulder with insurers on the other. So let me tell you what reinsurers know based on the conversations we've been having over the past couple of months. Not much. So we keep hearing that the number of companies, number of cedents reporting into reinsurers is significantly lower than the market share PCS is capturing. And what we're finding is that the market share we're capturing organically in the traditional sense of companies reporting to PCS, not including exactware data and other tools that we use, that alone is far higher than what reinsurers are seeing in the market right now. We're also finding that some of the reporting in the reinsurers may not be as complete as what's coming into PCS as well. So as far as what the market knows versus what PCS knows, there is a big disparity, and that is shaping a lot of the perspective in the market. We're finding that the companies that are coming and talking to us, frankly, about this are actually learning a lot relative to what their clients are telling them. We also don't know about the large commercial impact right now. And this spans the insurance and reinsurance market. What we're finding is that the Harvey model of development is probably a likelier match here, where it's going to take a while for that commercial to creep in. We've got a $200 million limits loss on a large commercial property. You have a good sense that right away it's bad. But those 5s and 10s against a 200 or a 300 or $400 million tower, those take a long time to figure out. So we think that the process of understanding large commercial loss could go on for just kind of getting started, could go on for a while. So in terms of what we know so far, as an industry, surprisingly little. Now, I'm going to kick to Ted for a second because he's actually been on the ground in Louisiana and talks to the insurers who report to us. And he'll give you a better sense of what we actually know.
Sure. Thanks, Tom. So quite a lot of uncertainty still, and also it sounds like already looking like this could be an event with a tail that develops well into next year. So yeah, Ted, moving over to you now. Your team obviously deals with the claims data as it flows in from market participants. So what in your opinion has been particularly notable about the Hurricane Ida claims picture?
Well, thanks, Steve, and thanks, Tom. From my perspective, and I like to say that early in November, in fact, I had the opportunity to spend some time on the ground in Louisiana, meeting with adjusters, contractors, homeowners, and suppliers. And in fact, I came away with 3 primary takeaways during that trip on the ground prior to our first resurvey. The first takeaway was that there's still a significant issue with respect to supply chain availability of materials, et cetera. And in fact, the costs associated with those materials that are available are still elevated, even 3 months after the storm. Second takeaway that I got from my on the ground meetings was also a significant depletion of skilled laborers being available in the region to perform and effect the repairs that are necessary to properties. From some of the conversations that I had on the ground, commercial as well as residential, there are some that are going to be waiting 4, 6, even 8 months to have permanent repairs affected to their properties, which in turn translates into my third takeaway is the supplemental payments and supplemental inspection issues, which is going to affect the LAE as well as, of course, the overall loss for many of these insurers, because, of course, as these damages are taking much longer to repair, costs are still going up, and potentially additional damages are being done to many of these properties while they're sitting and waiting for physical repairs to be affected from this storm.
And do you think those issues are sort of being borne out in the data that you're seeing so far?
At this point here, it's still early in the game, as Tom has indicated. However, from being on the ground, many of these re-inspections are being conducted as we speak. So we don't do a lot of forecasting on our end. We look at the data as it comes in. However, we do expect that there may be some additional development, as you referred to, as a result of those 3 key takeaways in the upcoming months.
Yeah, and those are really important issues that often people in the insurance and securities market, for example, particularly the investors, maybe are not as attuned to, because they don't really get to see or hear about how catastrophe event recovery occurs on the ground. So that's really interesting. Thank you, Ted. So moving back to you, Tom, if the industry is finding it challenging to put a figure on Ida, it seems, for many reasons to do with the complexity of the event, and obviously it's a very big and wide-ranging loss event as well. But are there similarities emerging in Louisiana, do you think, similar to some of the previous losses in Florida we've seen that have crept significantly? And what should the industry learn from this event that they may not have learnt from previous experience?
There are plenty of similarities to past events, much as if you read Nostradamus now, you can find ways to see everything he predicted, right? So are there some similarities? Of course, right? I've already been guilty of that myself by comparing the potential for commercial development to look similar to what happened with Harvey. Obviously, you specified Florida for a reason. And there are a couple of ways where that could be similar. One, of course, is the long tail due to conditions on the ground. Obviously, different driver, because AOB was the Florida issue. Louisiana would be something different, likely materials and pandemic. You could also, I guess, look at Irma in Florida for the dip from the second number to the third. Nobody has forgotten that, how we went from one number to a lower number and then up and up and up. There are some states in the Northeast, for example, where you could see a possible bounce back. We don't forecast, as Ted mentioned, and it's worth mentioning again. But is there the risk of upward movement following a decline? The past has borne that out, particularly a Florida-based cat, although this wouldn't be a Florida loss. There are some comparisons to Sandy that could be made with flooding. So there's a lot happening here. It is not just a big and a complex cat with 2 major underlying components to it that can be seen as quite different from each other. There's also stuff in the middle. Not a lot of people are talking about the large commercial losses from tornado in Pennsylvania and South Jersey. There's, in the rush to find what this is based on historical events, there's a tendency to ignore what actually happened and what that can mean for your book now. That's the lesson. It's like, all right, guys, stop listening to Front Street gossip. Stop trying to find what cat this most looks like. Talk to your cedents, talk to PCS, look at your data and figure out what's going on.
Mm. Yeah, no, it's certainly turning into an interesting one for the industry to learn from. That's for sure. Ted, I guess it'd be interesting to hear from you whether you're also hearing any. I mean, you've been on the ground in Louisiana, but what have you heard from the damage that occurred further north? Tom mentions tornadoes. Is this something that's coming through in the data you see from clients?
Indeed, and with respect to that in the Northeast, one thing that we've found in many of our discussions is that many of the claims counts initially, companies did the proper thing by looking at what their particular exposures may be, but they're finding after having the assessments done, the inspections done by the adjusters as well, that there is a pretty significant percentage of claims that are actually not being found not to be covered due to the fact of a general and temporary condition of flood affecting properties. And so that percentage of closed without pays in the Northeast has been increasing based on the data that we've been receiving from many of the insurers.
Mm. Yeah, and flood risk is always an interesting one as well when it comes to commercial, because often the commercial flood risk can end up flowing to the reinsurance market, where the primary or residential flood risk can typically be managed by the NFIP. So I guess there's a lot of uncertainty there as well about how the flood damage will split out. I actually saw a number today suggesting that the Northeast flood damage economic loss estimate could be anywhere from 30 to 40 billion, which is really significant.
Exactly. Yeah, I mean, it's so difficult to calculate though, because when you look at professional services losses, for example, you can't benchmark to a 40-hour work week for employee cost. In the Northeast, restaurants are always tricky, particularly with the pandemic right now. So it's easy to go aggressive. And some of these estimates speak to another risk that's creeping into cat risk, and that is political risk. Let's not forget the role of political risk in Hurricane Sandy in New Jersey. Well, not a hurricane in New Jersey, thanks to that political risk manifesting almost a decade ago.
Yeah, no, so the willingness to declare things a disaster and to get the right people in the right place so that people can recover quicker sometimes is a bit lacking, and that's certainly a risk that seems to be elevated at this time. Ted, I guess from your time on the ground in Louisiana, is there anything that you think the industry might not have fully understood to do with this loss event? Anything other than those three issues that you mentioned?
Yes, in fact, Steve, the impact from prior years is still affecting the Southeast region as well, Louisiana, in fact. There's still quite a large number of homeowners and business owners that are still contending with losses from Laura, Delta, and Zeta, and that effect is still being felt throughout the industry. In fact, those events are still open from our PCS perspective. We're still looking at many of those also. So companies shouldn't forget those prior years, 2020 losses still being out there, along with Ida, when they're looking at their portfolios.
Yeah, no, it's interesting because obviously Louisiana has been particularly badly affected by hurricanes the last 2 years now. Is there any risk of losses from 2020 falling under 2021, or is that are they far enough apart, these events, that that shouldn't be an issue?
We look at them individually. Of course, from PCS, we designate each event on its own terms. However, when it comes to the conditions that are on the ground, the material shortages as well as the labor shortages, each of those events from 2020 as well as 2021 are usurping resources. So that shortage is only expanded by Ida and what happened on the ground back in late August, early September.
Yeah, no, that's a very good point, that the supply chain and inflationary issues can just exacerbate the following season, I suppose, when they've had such a severe number of storms impacting in 1 year. So it's always useful to talk about loss creep potential, and we've already spoken about that a little bit and identified that there probably is some. But Tom, how high a risk do you think there is that the industry is looking at adding a number of billions to the total figure by, say, February next year?
A clever way of asking me for a forecast. asking me for. I mean, look, we see the potential to create. We see that potential being significant because there are a couple of dimensions to that creep. You know, Ted spent quite a bit of time on a homeowner market materials related. We talked about where the commercial risks could see some creep as well. Political risk could be a factor in bringing Northeast homeowners in. So there are a lot of different ways this can happen. And, you know, let's not forget, you know, the elephant in the room, which is COVID, which is not only its own risk for elongation of the claim life cycle and impacting how adjusters interact with claimants, it also impacts all the other risks we discussed, right? It provides lift to those factors in different ways, which is, you know, truly the manifestation of the systemic factor kind of permeating the loss creep environment. And that, right? Because you've got, you know, obviously the supply chain implications are well documented. It's had just spent a lot of time on materials and qualified resources. You've got issues with, you know, understanding the loss, right? There were early attempts to use aerial imagery after the storm, but because of cloud cover, it didn't work out all that well. Okay, so you've got, you know, efforts at remote adjusting based on, you know, the need to maintain social distance and also overcome access issues, which were stymied by follow-on activity. So there's no simple answer to this, but we've looked at pandemic increasing or affecting loss creep in other areas so far as well, outside of CAT. So Latte Chemical in South Korea, Golden Ray marine loss. There's no good news for us to bring. I mean, being with PCS, we're used to being the bearers of bad news. It's kind of what we do for a living. And we're unfortunately going to have to stay true to character.
Well, you might call it bad news. I'd say it's a good dose of realism for the industry, though, and the clarity is required because people do need to know, or people need a better picture of where they stand at this time of year. Ted, anything to add from your side on the sort of potential for this to be an event that creeps over the coming months?
Well, of course, the potential is there, and you know, in looking at PCS's historical losses, this event Ida is already number 3 in the PCS database right now, very close behind Irma. So based on the things that we've already spoken about during this podcast here, it's pretty safe to say that we may have a change in the top 3 based on the factors that are on the ground with the, again, material supply, labor shortages, supplemental payments, and then of course the other issues that Tom just mentioned as well.
Yeah, no, thank you, Ted. And so finally, we're obviously very close to the reinsurance renewals now, and already those renewals are seeming to be very late this year. And Ida, I think, is probably one of the many issues that are causing some of that lateness. But Tom, how big a deal do you think the Hurricane Ida situation is for this renewal, and what are you telling PCS clients to watch out for?
So it's interesting, right? The first thing I do in that conversation with clients is look at where we were 12 months ago. And ultimately, this point in 2020 was really frustrating because rates didn't go up as much as reinsurers hoped they would because new capital came in. Not enough new capital came in to allow buyers to maintain their buying behaviors, you know, based on cap availability and so forth, right? So basically, everybody kind of felt the pinch, but nobody got enough upside to be satisfied with the outcome. I think there's a fair amount of that that's coming fair again this year. Now, part of that is expectation, right? You know, in the old days, back when we had, you know, in-persons at Monte Carlo and Baden and PCI, there always used to be a wave of October press releases from some players calling for 2-digit or double-digit rate increases again as kind of their public diplomacy style opening for what would be a moderate uplift on loss free programs. Yeah, those expectations I think are still probably not realistic, but people will come in high to manage to those expectations, their real expectations over time. IDA certainly doesn't help, and the timing makes it worse, right? You know, the particular curse of I and L storms and where they hit during hurricane season is that they wind up influencing the renewal in part by when the estimates fall. And we just had our most recent estimate a little over a week ago, and we get our next one on January 20th, which puts 1/1 about as close to the middle as you can possibly be. Now, I think we have some work to do as an industry in figuring out how to manage what happens during those 60-day periods between PCS resurvey updates. We've been talking to Exactware a lot about their Exact Analysis Insights tool, and how we can use that to understand what's happening between the 60-day updates for kind of homeowners and small commercial. And it's going to be interesting to see how that evolves. And we have a couple of clients who've signed on for that, so they'll probably have a leg up on understanding what's happening right up through the 1/1 period. We do figure that the renewal showing signs of being late again. We think the ILW market's going to be reasonably robust, as it would following a big loss, right? UNL retro is getting harder to come by. Now, what's interesting with ILW dependence is that as a buyer, you don't have to telegraph your moves as much, right? UNL requires data, discussion, understanding claim handling practices and underwriting philosophy. ILW doesn't require any of that. So you can basically do all your thinking and planning and so forth. You can talk to a couple of different brokers to see what's going on with which markets, and then pile in fast without having to reveal too much of your thinking or your intentions. I figure that's going to happen. Whether it happens before or after January 1st, I think it'll be part before and part after. There are always a few folks who keep some powder dry to come in and try to clean up afterward. I think you can expect a fair amount of that. I wouldn't be surprised if there's some cat bond issuance following that process as well, just given what was done with like Herbie and Clavo and how those could be kind of stood up and moved pretty quickly, given their ILW style. I think there's room for some Q1 retro buying on that basis. That could be pretty interesting. And if all goes kind of true to form, if there is a late renewal that's wrapping up kind of in the middle of January, then it doesn't take long to see what our next number is to drive the wave of ILW buying that's always done to tidy up what comes after the 1/1 renewal.
Yeah, no, that's interesting. That's very much what I'm hearing from people in the market, is that there's probably going to be a bit of sort of buying based on indices through the renewal and after the renewal, because you really haven't got to make the same disclosures around your own book and your own losses, and you can price it based on the industry loss expectation rather than specific portfolios, which at this point, with losses still developing, is kind of difficult, particularly in the and I guess the worldwide retro deal's even more difficult if you've got European flood risk in there as well, or European storm risk in there as well.
Not on European, Steve. We've been approached by several players in the market to expand our reporting to that. And it's something we're contemplating doing on a bespoke basis. We could make it easier for some of those deals to get done. We've found obviously that the new kind of streamlined PCS indices have really helped the market with some of these more frustrating risks. So, what we'd like to see happen with some of those is, hey, I have a couple of guys come talk to us about bespoke reporting for European flood by country. We also think people should start really looking at cross-border U.S.-Mexico cats as they do for, because Ted and I just went through an exercise where we looked through the historicals for U.S. Canada and U.S. Mexico. The latter is bigger and more frequent.
Yes, as evidenced by a few of the parametric cat bonds that have covered quakes on both sides of the border, which is obviously a natural thing you need to do in that region of the world. Look, thank you both very much. Don't want to get too far off our original topic, but great to talk to you both. Ted, thank you for your insights from your time on the ground in Louisiana. I'm sure the industry will find that really interesting. And
Thank
Tom,
you.
as ever, thank you very much. Both of you take care and talk to you soon.
Thank you, Steve.
Thanks, guys.